Hello, Jim here. I've been an income investor going back to the 80s. I have primarily invested in companies that have good fundamentals, pay dividends, and also grow those dividends over time. I today want to talk about two companies that I think fall into that criteria. They pay dividends, they're growing the dividends, but they also have really good options, premium, and volume. So I'm going to share with you why I like these particular companies and how they can actually help you double your dividends. So in a sense, if you're making between 3 to 4% on a yearly basis with dividends, you could potentially double that to 6 to 8%. So stay tuned. I think you're going to really enjoy what I have for you. Okay, the first company I want to talk about is T. Rowe Price. I've actually done a couple of vertical put credit spreads on them, and it's worked out quite well. They tend to kind of drift sideways, but go up over time. They also pay a really good dividend. 4.32% is the current yield. They also have a fairly low PE, price to earnings, of 12.19. So you can see here, if we go back 10 years, they've pretty much gone sideways. They did go way up back in 2021, but for the longest time, they've stayed right around this price range. So they don't seem to move too much away from that. Earnings, they beat earnings. They did miss revenue last time. And you can see here, they have fairly good year over year growth in their income over the next year. Not great, but not bad. If we look at it more on earnings estimates, we can see where they stand. So for December 2024, so last year it was $9.41 was the estimate, the earnings per share estimate. This year they're expected to go up a bit to 956, 999, maybe drop a little bit, but they steadily continue to go up. It looks like by 2031 they're going to be close to 1350 per share, earnings per share, that is. So not crazy good earnings, but steady, and again, kind of going sideways and moving up, which I think is also a really good situation for trading options on them. Like I said before, I've done vertical put credit spreads on them, and they pretty much expired out of the money. I'm not sure they ever even got in the money. So dividends here, we can see they have really good ratings for dividends. They pay 4.32. They have a fairly small payout ratio, 55%, which is good. I'd prefer to see that a little bit lower, but for a seasoned company that's well managed, that's not bad. 5-year growth rate, now that's pretty significant, and they've been growing dividends for 38 years. So if we look at the dividend history, we can see they've been increasing it over the years. So, if you go back 10 years, you can see it was back in 2014, they were paying 44 cents quarterly. Now they're paying $1.24. And that's why I really like companies that grow their dividends, because if you buy into them now, 10 years from now, it's a significant amount of income that you'll be making from the dividends. And that's what I've seen with Coca-Cola. I've owned Coca-Cola since the 80s. I've owned Procter and Gamble and Southern Company and several other companies that, just like T. Rowe Price, have been increasing dividends, and it's worked out really well. Dividend safety is good, which is what you want to see. The payout ratio is a little bit high. Prefer it to be a little bit lower. Valuation, let's look at their debt. I like to look at their capital structure. It's showing they're not overpriced. They're not, they're about right priced. So if we look at the capital structure, they've got their market cap's $25 billion, and they have $364 million in debt, so very little debt. And they have quite a bit of cash, over $3 billion in cash. Growth, they don't grow that quickly, kind of steady growth. And then profitability, they do have very good profitability. So they have return on capital around 12. I'd prefer that to be a little bit higher, and actually this is return on common equity is 20. This is return on capital 12, which actually is good. I was originally thinking that was return on common equity. And then their return on assets is quite good at 15. I like to see return on assets right around 15. or in the teens. The higher the better, of course. So they have good profitability. They're not a major momentum player. Now if let's jump over, so that was Seeking Alpha I was just in. This is Barchart's Premium. Now if you're curious about either one of these tools, I typically use Seeking Alpha as, looking at the fundamentals of the company. How do they look overall? How does profitability look, valuation growth, dividends, earnings, all the specific pieces. I can also look at the financials. So it's my go-to tool for looking at fundamentals. I do have a premium membership. I am an affiliate. So you'll see in the description if you want to give it a try. They do give you a discounted price if you go through my affiliate link. I will get a little bit of a kickback. I think, though, they give you a bit of a discount if you go through an affiliate. So, and then this is Barchart Premium. I also like it. I preferred it for technicals. It gives you a little bit more on the technical side. I like to also use the interactive chart here more so than in other places. But you can see here, its current price is fairly close to the bottom of the bar chart, the lower averages, which I kind of like it around 110 or maybe 105. We can also look at how much options premium they have. So I like to come down here to option prices. And this is 117, but we can see they have fairly good amount of volume and open interest. If I come down here to puts, same thing. So what I've found is that they have enough options volume, and you can do fairly well. So if I got assigned at 110 and then I sold a call at 115, I could still bring in fairly good premium, or even to 120. And like I said, they don't tend to move a huge amount. If we come back over here and go to the summary page, I mean they've hit 120. So why I like companies like this is they're a little bit easier to manage, kind of like Coca-Cola. I'm rarely have I had these get assigned away from me on either side. If you want to own them, then it's fairly easy to run something like the wheel on them and pick up some shares, and then it's fairly easy to run covered calls. And like I said before, you can control if it gets assigned or not. It's relatively easy to roll them since they don't move that much, but they do have fairly good options, premium, and volume. So that's why I like T. Rowe Price. Next, we'll turn to another company that I also like, that I've also traded on, but I currently don't own any of them. Just like T. Rowe Price, I don't have any shares. And they're also a great candidate for the option wheel, maybe the cash secured or the spread wheel, or even the monthly wheel. So let's jump into the next one I wanted to talk about. The next company is NetApp. Just like T. Rowe Price, I have traded with them before. I had a vertical put credit spread that expired. I believe it was maybe back in early October. They don't have a crazy PE, 15.98. They make software. I actually use some of their software, both when I work with AWS, Amazon Web Services, as well as Azure, Microsoft's Azure. As some of you probably know, I'm a software developer, so I work with both Azure and AWS. I also work with a lot of other Microsoft products. Since I'm a solutions type developer, I also work with their databases, and so just wanted to mention that they've been around a long time. They have a really good product line. We can come here and take a look. Now, if you're new to Seeking Alpha, I also like to read the different analysis that come from the different analysts. If you're interested in being an analyst for Seeking Alpha, they do give you a free premium membership if you become an analyst and you write these kind of articles. But I like to look at these articles. I like to look at the comments. We're going to come down and we're going to look at a little bit of description of what they do. So they provide a range of enterprise software systems and services their customers use to transform their data. So they do a lot with data, and it's all over the world. So they've got hybrid cloud and public cloud. It's funny how cloud is misspelled there. The company offers data management software such as NetApp, OnTap, uh, NetApp Snapshot, which I've used before, and then also Snap Center backup, for doing backup, especially if you're working with some of these data warehousing type of products. So just overall, one of the software companies that hasn't shot through the roof. A lot of the other software companies have got crazy PEs. So they have 15.98. So let's look at earnings. They did beat earnings recently on 11/21. Not by a huge amount, but they beat both the revenue. They had a revenue surprise and they had a surprise for earnings. And they're not growing by leaps and bounds, but they are growing okay. It looks like 10% for earnings in the fourth quarter of 25 and the first quarter of 26. We can also come up here. We can look at earnings estimates to see what they look like year over year. So 25, $7.32, then 7.86, then 8.55. So it looks like they're going to get not a huge jump, but definitely growing. They're a bigger company, so they're a little bit more mature. You're not going to see the crazy increases. So you might be wondering, why am I looking at NetApp? That couldn't be a dividend payer, but they are. They actually do pay dividends, and they've been growing them. So their yield currently is 1.78, which is on a yearly basis, or the forward basis is $2.08. Now their payout ratios are really low, only 28%. They're not growing them in a huge amount, which I kind of like this. I worry about companies that increase their dividends too quickly, but I do like to see them increasing it. So if we come to dividend history, we can get an idea of what it looked like. So currently 52 cents per share per quarter. If we go back to 2014, we're talking around 16.50 or right around 17 cents per share. So you can see it's gone up quite a bit. So at different times during the years, they've increased it. So here they increased it not a whole lot, 48 to 50. They 20 to 40. So back in 2018, they increased it quite a bit. So, and then safety, their dividend safety, it looks good. Their valuation, C minus. So again, they're not necessarily overpriced or underpriced. They're sitting at a fairly good price. You can see the PE is, compared to the sector median, is a bit lower. And then if we look at their capital structure, they got $2.2 billion in total debt, but their market cap is 23, so that's not a whole lot of debt. It's more like a 10% debt to equity ratio, which is okay. For these big companies, the way they manage debt, I would be more concerned if this was, more like 11 or 12 billion, but 2 billion is okay. Now growth isn't the best. Looks like actually their earnings growth looks pretty good, so they must be making some savings, expense savings. And their revenue growth, it's like 6% or 3% for forward looking. So their growth is relatively slow. They're definitely more of a value company than a growth company. Now profitability looks good. So here's a return on common equity, 138%. So they're a well-run company. Return on total capital, 26%. Return on assets, just shy of the 13%. So this is, again, another really good indication that they're a well-run company. Now, when I did the trade on them, I believe it was back in October, it might have been August. I believe their return on common equity was more like 80%. So they're definitely streamlining things and doing a bit of a better job. Now we can actually look over here. Let's jump back up to the interactive chart and see how that looks. So this is the Bollinger Band, and just like T. Rowe, they're right down here. They're closer to the lower band than the average. So, and that's what I prefer, is it to be in this area versus here at the top. and they did have a really big growth spurt. I guess when was that? Let's see. Earlier this year, and then they have come down a bit. So I wouldn't be surprised if they get a little bit of another growth spurt at some point. Now for their options prices, let's come down. And just like T. Rowe Price, I believe the vertical put credit spread might have also been right around 110. I think it was puts around 110. And then let's look at that real quick. So 110, you're talking, oh, this is this week. Let's go out a little bit. So let's go to 221, which would be 48 DTE, which again, I like anywhere from 30 to 45 DTE. Depends on the company. The longer or the higher the DTEs or the days till expiration, typically the lower strike that you can potentially, get with selling the put or selling the vertical put credit spread. The short strike can particularly, if you're trying to do it at say a 15 delta, so this is calls, but if we come down to puts at a 15 delta, you're right here. So it's 105. Now, if you only went out maybe 2 weeks, you would be at 110. So I prefer, especially with vertical put credit spreads, to be closer to that 15 delta. If I really like the price of the stock and I don't think it's overpriced and NetApp actually fits that situation, I would take a little bit more risk. So I would look at potentially doing a 24 delta, which is 110. And you can see here, it has some pretty good premium. So the bid, mid, and ask is right around 173 is the mid. And if I went $10 out, which is what I like to do, you're talking 53 cents. So I would try to get 125 per contract or 250 for 2 contracts. And then let's look at, so open interest looks fairly good, not a huge amount of volume. Let's see, with calls, well, they have a lot more volume and open interest for calls, which if you decide you want to own them and you pick them up at say 110, say they get assigned to you at 110, you picked up 175, so your basis is more like 108, and then you sell 120 calls on it, you can see you can pick up pretty good premium around that level. And if I a lot of times will sell calls going out more like 3 months. So if we do 321 and we look at the calls at around 120, you can see here, or even 125, $4, meaning NetApp has slightly better premium, maybe not as good volume. Well, no, it looks like with this expiration, it has even more volume, especially with calls. You can typically do better than doubling your dividends. So even though they pay a lower dividend, if we come back over here and we look at dividends, here we go. We look at dividends of 1.78%. I wouldn't be surprised if you could triple that. So you could earn, around 4.5% to 5%, mainly because you have a lot better premium with selling these calls. And just like T. Rowe Price, they don't move a huge amount. I mean, if we go 10 years, they did go up from the 60s to the 118, and they did have a big jump. When was that? That was probably back earlier this last year, April 22nd. So they did get a bit of a jump, but they've been increasing, their earnings and different things. So I don't particularly think that they're overpriced, especially with the fact that software companies, some of them have crazy valuations. And I think companies like NetApp, the developers that work there, if they're like me and they're using ChatGPT, it's a game changer. I'm able to be a lot more productive. I'd say my productivity with writing code is probably double because of ChatGPT, which is allowing me to do things a lot quicker. In the past, I might have handed off some work to developers overseas. I might have used Fiverr, or I might have used one of the other online tools where I can hand off some or get someone to help me code wise. And I don't need that. It's almost like having someone in a cubicle next to you that can answer your questions. So those are the two companies. Like I said, I've traded them before. They both pay good dividends, and between the dividends and the call premium, you can do quite well. So that's what I wanted to share with you guys. Let me know what you think. What do you think of these two companies? Do you have other companies you really like? If you do, please add a comment. I typically try to respond to my comments within 24 to 48 hours. And thank you for taking the time to watch the video, and I look forward to seeing you next time.